had a lot of results coming through on the South African front. Some have met expectations, other companies have really disappointed. But the point is that the stock markets at this stage have priced in very good earnings, and of course they're pricing in a robust recovery. Do you think that earnings are going to eventually match up to what we've been seeing coming through on the equity front?
You know, you spoke about 12 months ago, you know, and you spoke about the March lows for markets worldwide, actually nearly 12 months ago. And you know, 12 months ago, the picture in markets looked very, very different to what they do today. Then the price for the market was way below earnings, and you'd remember how massively volatile the market was 12 months ago.
Exactly, the Dow was in fact at 6,557
well,
points, and now we're over 10,000.
No,
so
absolutely,
big improvement
absolutely.
there.
But you know, the interesting thing is, if you go back 12 months ago and you go and you ask most people, if you sat during those times and you said to people, where do you think markets are going to go from here? People would probably have said invariably down. People would have said they're definitely not going to turn around. There'll probably be much more weakness, you know, and then they would have cited reasons why they believed there would be with so much more weakness. But the opportunity inherently in that was the fact that earnings were actually so high and price was way below what earnings were. And I mean, in essence, if you look at the price to earnings ratio for the market, you know, some companies were selling very, very low single-digit price to earnings ratios, and the market on average was selling of about a 6, 7, 8 price to earnings ratio, depending on when you were buying this market. And then from that high point 12 months ago, earnings have been falling and falling and falling and falling and falling, and have continued to fall through, you know, much of January and February this year as people have come through with their 12-month numbers. And prices continue to accelerate, apart from the blip that we've seen in January, February this year when the market was down for a 3-week period. And the question now is, you know, with price so far ahead of earnings, you know, what happens to the market from this point forward? You know, does it consolidate? You know, what is it that's going to happen to the market from this point forward? And that really, if one takes into consideration what is happening, some companies are meeting expectations, some companies aren't meeting expectations, but on broad averages, okay, the market is starting to bottom out. If you look back in history, you know, 12 months for earnings to come down. At some point, there's a turning point for earnings, and earnings start increasing again. If earnings start increasing, price obviously will stabilize, and we'll probably just see fairly anemic returns for markets this year. Well, alternatively, you know, if earnings really surprise on the upside, you know, you could see markets moving, you know, up quite a bit.
Because we're around 28,000 on the local bourse, and some say it's going to be quite difficult to see any momentum to the upside. Do you agree with that, Cobie?
Well, you have to, because I mean, you know, you've only got another 14% to go before you're at the all-time high, you know, for the JSE. Absolutely, you know. So, you know, for you to you know, to crest the peaks of the previous high, you've got to see some massive earnings growth coming through, which, you know, if you look at the numbers at the moment, you know, they're fairly flat at this stage. You know, we want to see a bottoming out effect as far as earnings are concerned. You know, and if earnings this year can go up by inflation plus 1 or 2%, you know, you've got a slight increase on earnings. You're seeing a bottoming out effect, and I mean that's good news for markets at the end of the day. You know, seeing the cataclysmic events that's happened internationally.
Well, looking at the rand, because that's also been one of the reasons that some of these companies haven't been able to report on great results. But at the end of the day, we know we've got a strong rand at this stage, so we just have to cope with it. To what extent is the rand going to put pressure on companies going forward, or do you think that perhaps businesses in South Africa are becoming a bit more clever about how to handle the very strong rand?
Look, you know, again, inherently in some people's business models, a strong rand will hurt their business model. You know, there's nothing they can do about that. The question is, they have to work on long-term averages, and they have to start, you know, take the very strong periods and discount those, and take the very weak periods and discount those, and try and work on long-term averages. The problem that you face is that and this is inherently in markets. Markets are pretty much efficient when it comes to currencies, and currency finds, or so I'd rather say capital finds yield. And at the moment, you know, the rand, you know, relative to what you can earn in pounds and in dollars and in euros, is very, very strong. And if you take that into consideration, you know, money will continue to flow into South Africa, making the rand stronger and stronger and stronger, and alternatively keeping it at these levels until we can start seeing either currency appreciation internationally, where they put up rates internationally, and in that case, you know, you'll probably see some money flowing out of South Africa. And that, you know, could be, you know, 12 months out, it could be 24, it could be 36, it could be 48 months out.
And what's interesting to note as well, I mean, credit profiles in Europe under the spotlight at this stage. We know what's been happening with Greece, and now Britain also under the spotlight, pound under significant pressure. So where else to put your money but emerging markets, and of course South Africa being a great destination?
Yeah, I mean, that weakens. I mean, that just weakens, you know, the you know, kind of G7 currencies. And then you see a flurry of money flowing into emerging markets. So it really is, you it seems that in emerging markets you can't have it both ways. It's either too weak or it's too strong. And that's unfortunately the situation that you have with an emerging market, is that you don't have necessarily the ability and the capital, to stabilize your currency. So therefore you're at the whim of the market, in the whim of what happens internationally. And you have to learn how to live with that.
Okay, looking at some of the data that we saw coming through in China, the trade data, and interesting numbers. We had exports up at 45.7%, imports surging at 44.7%. We've also got to remember that imports last month surged 85.5%. So, and some say that it's because of the Lunar New Year holiday, because we have seen a big chunk out of the trading days because of those holidays, Cobie. But at the end of the day, when you look at a country like China, we're obviously seeing robust growth there, and exports, imports under the spotlight.
Yeah, and look at the trend in China. So, forget about trying to look at the short-term data. If you look at the trend in China, they're urbanizing 1 million people a year. Your trade numbers are going to just continue to increase and increase and increase until they stop urbanizing people, and you potentially have a demand fall off either through economical changes or economic shifts in the country and so on. But those things are invariably quite long off still. You're sitting with a country that's growing very robustly at this stage, and they're trying to cool their economy, whereas G7 is trying to stimulate their economies. It's quite a juxtaposition to be in, if you think about it.